Hi, this is Paul Hitchcock with the Estate Asset Protection Business Planning firm Barth Calderon. So I'm talking to my colleague Jim Timar today, one of our expert tax professionals. We get a lot of tax questions when we're helping families and entrepreneurs to get their planning pulled together and organized, whatever they're doing. So let's go talk to Jim, and really appreciate you listening in. Jim, we're going to jump right into a very hot topic, limited liability companies and the taxes associated with them. We have a new tax law. People are kind of getting fuzzy on the rules. So what's going on with limited liability companies? You may touch on corporations too, but how they relate to taxes. What's the deal there?
So to keep this video short, there's a lot of information there. But specifically regarding the taxes, so an LLC is treated as a pass-through entity, which essentially means any taxable profit passes through to the partners of that LLC, prorated at whatever allocation is assigned, in their operating agreement.
Got it.
For tax purposes, if this LLC is an operating business with ordinary income, so if you're a member of an LLC, you're an active member and it's selling widgets, then that ordinary income at that, your allocation percentage will pass through to your personal return. That's where the taxes are paid. But the taxes in this case, because it's ordinary income, it's taxed higher. So the reason being is the profits from an active income from an LLC is subject to the self-employment tax. So the self-employment tax is roughly 15.3%. Consists of Social Security and Medicare taxes. So it can be kind of a killer depending on how much profit you've got coming through there. Conversely, many real estate investors that have rental properties, they will oftentimes hold their assets in an LLC.
Right.
Because for most of us that own rental properties, the income is considered passive. In this case, for passive income coming from an LLC, it's not subject to that additional 15.3% self-employment tax.
Okay, yeah, because this is a big issue on the asset protection side. When our firm, an asset protection law firm is dealing with rental property owners, it's like, okay, got to get in an LLC to protect yourself so they're not nailed on the tax side if they do that.
Exactly. And one strategy, especially in working with your office for a lot of the clients that we share, is for legal purposes, an LLC is oftentimes more desirable than a corporation or a subchapter S corporation. However, us as accountants for tax saving strategies will oftentimes really like our clients to use a subchapter S corporation. So in that case, what you can do is at the entity level, you form the entity as an LLC, and then we simply make a tax election with the IRS, electing for your LLC to be taxed as an S Corp. And then that way, with S Corps, there's different benefits. There's also some different hoops you got to jump through, but oftentimes it can really reduce the 15.3 self-employment tax on the profits.
Got it. Well, I know there's a lot more behind this when it comes to taxation and these entities. We're going to leave it here for now. That's great information. I think it gives enough for people to kind of get a feel for how it's treated. Always reach out to us with more questions. But Jim, thanks so much for jumping on. Appreciate it.
Absolutely. My pleasure. Thanks, Paul.
All right. Talk to you soon.
See ya.